Good afternoon, possibly good morning, depending on where you're listening to us from today. Welcome to another great educational webinar we have here at Advance IRA. We're going to talk today, though, a lot of times we talk about real estate, we talk about other different types of investments or loans. We're going to talk and focus on buying gold and silver and other types of precious metals inside of an IRA account. We brought on a great guest today who's going to talk really about the why and more importantly as well, when to invest in gold and silver, making that part of your portfolio. And that's can certainly apply to whether it's an IRA or even personal funds that you're looking to invest. My name is Scott Maurer. I'm the Vice President of Sales here at Advance IRA. I've been with the company for a number of years. Helped out a lot of clients over the years with different types of investments, and spent a lot of my time the last several years, though, educating people on the ins and outs of self-directed IRA accounts and what you can use those retirement dollars for. Obviously, precious metals, as we're going to focus on today, is one of the asset classes that you can purchase within a self-directed IRA, something that you typically cannot do within a brokerage IRA unless you're looking and buying into an ETF or some other type of fund that is tied to gold or silver. But what we do at Advance IRA allows you to buy the physical gold and silver coins and bullion that we're going to talk about today. Just a quick disclaimer, at Advance IRA, we do not give any investment advice and we don't endorse any particular products or investment providers, though we did bring in a great guest presenter today to talk more specifically about the precious metals markets. The information that we provide is for educational purposes only. If you do have questions about the content, certainly welcome to reach out to me, but if you want some advice, we can give you the names of an attorney or an accountant or other financial advisors who can assist you as well. Just a little bit about our company, Advance IRA. We are a self-directed IRA administrator. We currently hold over $2.5 billion in assets under management for the number of, I think, more than 11,000 clients that we have here under that we administer the accounts for. One of the things that sets us apart at Advance IRA is our customer service experience. We pair every new account with a dedicated account manager so that each client has one point of contact for anything that they need regarding their account, whether they're making an investment into one of the alternative assets that we can hold, or if you just have simple questions on your account as well. We also offer a number of great educational events, live seminars. We do 1 or 2 webinars per week. We offer networking events as well for people really to learn more, not only about self-directed IRAs and how you can use your IRA to invest into real estate and precious metals and the other things that we hold here at Advanta, but also we like to bring in, like I said, guest presenters as well to talk about those ancillary topics that surround self-directed IRA accounts as well. If you ever miss a webinar or even the one that you're listening to, if you're listening to us live today, we have a great video library on YouTube. All of the recorded webinars. We have a podcast as well. We put the podcast recordings on that page as well. So a lot of just great information on our Advanta YouTube page. Now, as we talk about self-directed IRAs, and we're talking today about investing in precious metals, gold and silver inside of an IRA account, it's important to understand what types of accounts, what types of money can be used for these types of, investments into precious metals or something else that's self-directed. It's just important to note any type of IRA account is eligible. So if you have a traditional or a Roth IRA account, or if you own a small business or you work for a small business and have a SEP or a simple IRA, any type of IRA account can be self-directed. You can move money over into that type of an account and be able to take advantage of the alternative assets. Also, any type of old employer's plan. So if you worked for a company, you worked for the government, and you have an old 401k or you have an old 403b or maybe a thrift savings plan, once you're no longer working for those employers, you can roll that money over into a self-directed IRA and then use that money to invest in gold and silver. So in addition to the IRAs, the old employer plans, we also offer health savings accounts and also education savings accounts. Those are not retirement accounts, but they follow a lot of the same tax rules, whether you're looking to save and have tax advantage savings for your health or for the education of an individual. Now, to get money moved into a self-directed IRA from another custodian, It's either moving that money via transfer or rollover. And a transfer is when you move money directly from one IRA account to another. So if you have an IRA at Schwab or an IRA at Fidelity, you can directly transfer funds from that IRA into a self-directed IRA. There's no tax consequences to move that money, and you can move over as much or as little as you want. So there is an important thing to note when you're doing transfers or direct rollovers from an old 401k account. It does not have to be the entire amount. You can move over just what you need, for example, to invest and buy gold or silver within your particular account. So it transfers from IRA to IRA. If you do have money in that old employer's plan, it is considered a direct rollover. Again, both transfers and direct rollovers are non-taxable events. The money is going from one account at one custodian to an account at another custodian without that money touching your hands. So it is not a non-taxable event. The process for moving the funds can take anywhere from a few days to maybe a few weeks, just depending on the type of an account that you have and ultimately who your other custodian is. So before we bring on our guest here, just to touch on a couple of things regarding precious metals in an IRA. Greg today is going to talk more about the market, the precious metals market in general. But when it comes to the precious metals inside your IRA, there are certain requirements and some rules that the IRS you need to follow. Certainly, there are some metals that don't meet the IRS defined finest requirements. Typically, if you're looking to invest in gold, silver, platinum, or palladium, the metal needs to be 99.5% pure. There are other types of, precious metals products out there, other things that you could invest in maybe on an individual basis. But from an IRS perspective, it has to meet those specific fineness requirements. And just because a coin was minted by a government doesn't necessarily make it qualified to be held in an IRA account. When you buy gold and silver through your IRA account, the IRS rules require that you have that metal stored by a third party. We work with a number of different depositories around the country that will actually physically store and hold the metals in your IRA account. You are not allowed to hold that many metals personally. There was a court case that someone was trying to use an LLC as kind of an end around with that requirement. But the IRS, again, the tax court in that case said you cannot physically hold the metals if they're being invested in using your IRA account. And although the precious metals coins can technically be used as legal currency, you cannot use metals as a contribution to your IRA. So if you're holding metals on an individual basis, personally, you can't just make those, put those into an IRA as a contribution. You must have cash in your IRA, actually purchase the metals from a particular dealer. And most dealers, and certainly, the people we have talking today about precious metals can help you determine which products will satisfy those requirements. Again, in general, the metals typically allowed are gold, silver, platinum, and palladium. You can purchase 1 ounce, half ounce, quarter ounce, or 1/10 of an ounce U.S. gold coins and 1 ounce silver coins that are minted by the U.S. Treasury. Some of the other countries that are, that mint coins that are permitted are Australia, Canada, and Great Britain. In addition to the coins, you can also purchase certain bullion bars or rounds as long as they meet the fineness requirements. And maybe Greg can go a little bit more detail about that or talk about that when we bring him on in just a moment. Unacceptable products, though, things that you cannot hold inside of an IRA are any rare or collectible coins. And I know that we had somebody ask about this years ago, something called a Dory bar or Dora bar, where it's not, again, those bars might contain some degree of gold or silver in them, but they don't meet the fineness requirements required by the IRA. It's by the IRS. So that's just a little bit of background on IRAs and the precious metals industry. As we go through the presentation today, I would encourage you, if you're listening live, if you have a question, type that question into the question box and go to webinar. I will make sure that either myself or Greg gets that question answered for you as we go through the presentation. Just get those questions typed in there. But this time I want to bring on our guest presenter, Greg Allen, who founded Allen House Metals back in 2017. They offer the purchase, sale, and storage solutions for precious metals. I've known Greg for a couple years now. He and I talk a lot. We're both big hockey fans. Greg, though, actually played professionally for several years. I certainly did not. So Greg's going to come on and talk about really, the why and when to invest in precious metals. I'm going to make him the presenter here as we come aboard. But Greg, happy to have you come back on board again with us. It's been a few months since the last time I think you came on, and I know things have probably changed a little bit in your industry.
100%. Yeah. And thank you again, Scott, for having us back. I know that these webinars, just as an educational tool, are fantastic, right? So I appreciate you having us back on. And just to reiterate, like Scott said, if you do have a question, there are no stupid questions. Please don't hesitate to ask. Happy to answer any questions you may have. And, we find typically with precious metals investments, there may be a few additional questions, and that's normal. There's a lot of moving parts to these types of investments, just from the sense that you're not physically holding it, it's stored somewhere else, and it's a physical commodity, right? Just before I dive into things here, I wanted to touch a little bit on what you were saying, Scott, in terms of what metal actually meets the requirements that the IRS sets out for an IRA. One easy thing that you can look for when you're purchasing metal, no matter what type, whether you're looking at bars, coins, or rounds, is for certifications from LBMA or from COMEX. LBMA is really the gold standard when it comes to looking at physical bullion itself, the London Bullion Market Association. Mints that are approved by LBMA are mints that are delivering 999 or quadruple 9 products in terms of fineness. And because of this, their resale value tends to be higher as well, because it's tradable on the open market. Like you said, it's not dealing with collector coins or anything like that. And that's a big thing, right? We want to stay away from the collectibles. At the end of the day, what everyone here is looking to do is invest, diversify, and ultimately you want to buy low and sell high, right? We're not here to collect. So without further ado, I'll just get into things here. I just wanted to start briefly by going over our primary objectives, or our core values, if you will. First and foremost, we understand that, transparency is really important, right? Your comfort level and your understanding, and understanding what you're doing and what you're investing in, they're really paramount, right? Because no one wants to make a decision that they don't feel educated enough to make, or that they feel is rushed, right? So that's really important to us, and really we're here to educate you and help you make the decision with the facts, right? We want decisions based off facts and not emotion. And really, I think one thing that we think sets us apart here is really, we are a full service precious metals dealer. And what that means, we're here to make your experience convenient, and we work with your Advanta account manager from the start to the end of the process. You don't have to worry about playing middleman of us communicating with your account manager at Advanta. We deal with all of them. They're wonderful people, and that's something that sets Advanta apart as well. And really, at the end of the day, you can count on us to make sure that your transaction goes smoothly. I think ultimately, understanding your objectives and your risk tolerance is going to be essential for us understanding, whether gold, silver, platinum, or palladium are a better fit for you, right? There is no one cut and paste answer to the question, which metal is best for you. It really depends on your goals and your risk tolerance. So just a little bit more about us. We are a registered dealer with a company called Dill Engage that you see up on the screen. Dill Engage has been around, as it says, since 1976. And I know it says up there, they're the purchaser for the United States Mint. They are actually the purchaser for virtually every government mint in the world. So United States Mint, Royal Canadian Mint, South African Mint, the Perth Mint, on and on and on. Okay, they are responsible for importing the lion's share of metal into the United States From there, they're the ones that distribute to institutions, banks, financial institutions. You'll see brokerage houses, jewelers, miners. Everybody works with Dill Engage. We use Dill Engage mainly for the purpose of shipping and storage. Okay, they're located in Dallas, Texas. And in terms of transactions outside of an IRA, we ship anywhere within the United States, no charge to the customer, FedEx, 48-hour delivery, fully insured. Okay, to give you an idea on the size of Dill Engage, they're importing roughly $1.5 billion. That's a billion with a B, $1.5 billion worth of gold, silver, platinum, and palladium on a monthly basis. So you don't have to worry about running out of stock or us not having a product you're looking for. We've always got it. And moving on, part of the reason why it's so advantageous to IRA customers is IDS, International Depository Services Group, which you guys will see is an approved depository of Advanta as well, is a wholly owned subsidiary of Dill Engage. Okay, they've got locations I have listed here as Texas and Delaware. They also do have locations outside of the United States as well. The convenience factor and the reason why we recommend people use IDS Texas specifically is because IDS Texas as a depository is actually located in the same building as the warehouse for Dill Engage, which we ship from. So when you make a purchase, once we complete the purchase process with Advanta, they will literally put your metal on a pallet and walk it over to IDS before it's deposited. And even though it's coming from the same facility, the metal is completely audited. They go through every bar or every coin in every round, and they will test them to make sure it meets the fineness requirements that we are quoting. So for instance, if we're saying we're depositing a 999, so 0.999 fineness silver bar, they're gonna make sure that it is in fact 999 before it's deposited. The other benefit is because it's in the same building, when you wanna liquidate, it's actually quicker to get money into your hands liquidating metals at IDS Texas than if you were to sell a stock. Typical rules when it comes to selling stock, right, is T+3. We had a client this week, for instance, with Advanta, who needed to liquidate a portion of her funds. She received money same day. So if one thing that's been holding you back is the liquidity aspect to it, there really is no fear. You move out of cash into metal and out of metal into cash instantly. It's a really seamless process here. So just moving on, as we get into it, why gold and silver, right? Why buy gold and silver? Well, number one, they function as a safe haven, right? So precious metals are there to protect and preserve your purchasing power, right? They go up in value over time with the cost of living. They tend to offset large portfolio declines, right? When paper markets decline and there's turbulence, you see gold and silver rise. Additionally, I would say the main aspect that draws people to precious metals is safety, right? By definition, the safest, most conservative thing you could do is buy precious metals, right? Whether you're offsetting risk that you face in the market, or you just want to put your money in something that's going to match inflation that you're not worrying about checking every day, metals is there for you. A key thing that I would like to point out here as well is everything that you're noticing I'm saying, no one here is suggesting that you put 100% of your portfolio in precious metals. Ultimately, we understand diversification is the key to success, right? Everyone's heard the saying, don't have all your eggs in one basket, right? And really what metals allows you to do is keep your portfolio balanced and tangible, right? Gold has often been referred to as the ultimate crisis commodity because it can't be, devalued by overprinting like fiat currency. And ultimately, it's universally recognizable around the globe. So
Hey, Greg, if you can, I have a quick question. Again, I encourage everyone who's listening live to add their own. Is there a percentage? I know you said making it a part of your portfolio. Maybe this will be something you cover, but is there a general percentage people should or should look to have as a what percentage of their portfolio in precious metals?
100%. So something I will go in more depth with this in a coming slide, but ultimately we see from studies carried out over the last 50 to 75 years, and I will show everyone the data for this, the recommendation is a weight of 25 to 30% of your portfolio. This can slightly change depending on how many streams of income you have, what you consider yourself. Are you an aggressive investor? Are you someone who's just looking to meet a target return of something like 7 or 10% annually? These are things that go into it. But CPM Group did a 50-year study from 1968, and it ended at the end of 2018. Ultimately, they came to the conclusion that 25 to 30% of your portfolio in precious metals is the ideal weight. It will offset the risk, the additional risk you face in other markets with the 75 to 70% of your portfolio. But additionally, you're not giving up the potential for increased earnings, right? We have to keep in mind that a little bit of risk is good, right? Risk is not a bad thing. You just have to understand how much risk you're willing to face and take the right steps to mitigate it, right? So I think, one of the things we're just talking about here is for people who are just looking for metals, for their portfolio to meet or beat inflation, we see a lot of these people looking more towards gold, right? Throughout history, gold has been steady Eddie. Typically, there's more interesting things to do than just watching gold day to day. But what we know is it increases in value with the cost of living. It beats inflation year over year. When we have people whose goals are going to be more oriented towards capital appreciation, those are the people that we get that are really looking at the opportunity in silver. And I'll explain in a little more depth here as we continue. One thing that I really wanted to touch on here is, when you're looking at investing in precious metals, a lot of people ask, should I buy an ETF? Should I invest through futures and options or stocks? Or should I buy physical metal? One thing that we notice with ETFs, and it's twofold really, right? ETFs starting in 2020, like GLD, SLV, they changed their prospectus. It used to be the case that these funds were required to back the fund with physical precious metals. So GLD by gold and SLV by silver. And furthermore, at that time, if you bought a certain amount of units in the fund, you could exchange them to take physical possession of metal. They've since changed their prospectus. So they no longer have to or do back their funds by physical metal. The concerning thing about this is that if the funds aren't actually backed by metal, the only thing that's causing them to go up or down is the volume, how many units of the fund are being bought and sold. And so not only have these ETFs not tracked as closely to the physical metal here, but the additional risk that investors take now when they buy GLD or SLV is that the fund can liquidate at any time without investor approval and give you liquidation value, okay? And that's something that, for me is concerning. Additionally, I think a lot of the reasons we see people go to paper investments with metals like ETFs, futures, and options is because of liquidity. I wish it was the case in the metals industry that every dealer made the liquidation process as easy as we do. Unfortunately, they don't. When it comes, like I said earlier, when it comes to buying and selling physical metal with Allen House Metals, you are liquid most times same day, if not within 48 hours, okay? This is something that, when a lot of investors I speak to here, their notions of maybe considering an ETF or a future or option go out the window. You are completely liquid here. Another thing I just wanted to point out about buying, futures and options for precious metals, it is quite literally the riskiest thing that you can do. Just as a data point, and I don't know if this is new information to a lot of people here, but only 10% of contracts are actually exercised. The overwhelming majority expire worthless or are losers. A stat that some people have quoted in the past is that 90% of futures contracts expire worthless. This is a misnomer. It's more in the neighborhood of 30 to 40% that expire worthless, but the overwhelming majority being around 50 to 60% expire as they're sold early for a loss. Now, just a couple other things. Metals is a value store. It's a store of value, right? What that means is that whatever the price of gold is today, it will buy the same amount of goods that it does today 100 years from now. Meaning, if gold's sitting near $2,000 today, and let's say a MacBook costs $2,000, in 100 years from now, with inflation, if a MacBook costs $8,000, you will still be able to buy that MacBook with the same amount of gold as you would today. It works as well if we reference 100 years ago, right? All of the goods that gold would buy 100 years ago is the same case today, okay? The other thing is, right, during high inflationary periods, metals rise while stocks typically plunge. And if we look at what happened over the last, 3.5 years, it's a great case study. When we were seeing high inflation figures getting near double digits, we saw silver make a move from $11.82 all the way up to $30. So it almost tripled in price. At the same time period, we saw gold move from $1,400 to almost $2,100, $2,080. Okay. Additionally, the ultimate thing that we're looking at, right? You see inflation, deflation, stagflation, is the dollar. The number one thing that affects the price of gold and silver. And if you get anything from me today, I want you to remember gold and silver share an inverse relationship to the US dollar. So every day right now, your purchasing power is eroding. If we were to say that we took $100,000 in cash in 2020 versus $100,000 in silver, it's a shocking comparison, because if we look at inflation over the last 3.5 years, it's a total of roughly 29% or $29,000 you would have lost out of that $100,000. So that $100,000 is now worth $71,000. Okay, $100,000 worth of gold from the same period would currently be worth in the neighborhood of roughly $155,000. Okay, and the value store is really what we're looking at in terms of protecting our purchasing power and offsetting risk, right? Now, moving forward, this chart here, what I want to focus on is the dark blue line up here and the light blue line right here. Okay, that is the nominal gold price and the nominal S&P 500 index price. Okay, these are both indexed to 100. Okay, what that does for us is it means in 1968, if we use a starting point for the S&P and gold, both at $100 a unit, where would it be today? It's shocking to see that, and by the way, this is from the 50-year CPM study I was discussing earlier. Gold has outperformed the S&P given an equal starting point, right? The S&P, you'll see a nominal price is $3,000 as of 2019 at the end of the study, whereas gold is $4,000. Obviously, we all know right now gold is not sitting at $4,000 an ounce. It's just under 2,000. This is given the same starting point, indexed to 100. Really important to remember. And I think at the end of the day, this is a fact a lot of people aren't aware of. Now, moving on, we're getting more towards that target allocation, right? If we look at this chart, I know it can seem confusing. What this is showing you is your risk versus reward with having gold as a part of your portfolio. When they refer to risk on this table, though, it's different because gold and silver are safe haven assets. They're not referring to risk you're taking on and buying gold and silver. They're referring to the risk you're leaving on the table by not buying a riskier investment, right? So what you'll see is 25 to 30% is going to give you in the neighborhood of 7.8 to 8% returns annually. And again, this was over 50 years. Now, if you weighted your portfolio at 70% precious metals and 30% T-bills and S&P, you could have made a bigger return year over year. You'll see it's over 9%. However, you would give up the chance that you have in other markets to take riskier investments that might have better performance in the short term, which is why we say 25 to 30% is typically a target allocation when it comes to this here. Moving on, this right here, this pie chart diagram is an example of what the target allocation looks like, what an aggressive investor looks like, and then the example of Ray Dalio. So Ray Dalio, for those of you who don't know, is the founder of Bridgewater, largest hedge fund in the world. And you'll note he has 7.5% in gold, okay? The aggressive investor in this case is someone who they consider that has 6 streams of income. With 6 streams of income, the target is 10% in gold and silver. Reason being, you can afford to face a little more risk in other markets, given the fact you're counting on so many streams of income. It's not just your income from your job, you have income coming from multiple investments, and you can afford to take a little more risk. The rebalanced or target allocation of 25% metals and 75% other investments looks similar to some as what would be called the permanent portfolio, okay? They typically weight other investments here as S&P, and T-bills or cash, okay? For the most part, when investors had 25% metal in their portfolio, not only did it outperform during downtimes in the market, but your average year when you have a bullish equities market has higher returns when you have metals in your portfolio as opposed to having all equities, which is really profound, right? Moving on here, like I was saying earlier, right? There's ultimately no one size fits all answer, whether gold is better, silver's better. Like I said, one of the major things that we see and we ask are, what are your investment objectives? I tend to find that people who are just looking for stability are people that are investing in gold. People who are considering capital appreciation are looking at silver. Main reason for this would be the gold to silver ratio, which we're going to explain coming up in the next slide. I think the ultimate thing here is we want a diversified portfolio, not just in adding metals to it, but even when considering metals. I would say roughly 85 to 90% of our clients have a mix of both gold and silver in their portfolio. They don't have just gold or just silver. The main reason for this, like I said, is staying balanced and diversified. So moving on, I just want to show, this illustrates my point with the risk to reward ratio in terms of gold and silver a little more clearly. If we look down the portfolio weights, you'll see the top one highlighted in yellow is gold. The bottom one highlighted in silver is silver. The weight of gold and silver go from 0 to maxing out at 70%. The returns are on this far left column here that you see. I don't know if you guys can see my mouse moving up and down. The key thing that you're going to notice is that the risk versus reward ratio with gold and silver is fairly similar when you're lower end in the spectrum. So moving up to roughly 20-25%, they stay fairly similar. When you get above 25%, you'll notice that the risk of having heavier weights of silver as opposed to gold in your portfolio is higher. Reason for this being, silver tends to be more volatile than gold, right? There's potential for much more upside, but you do see swings because of that, right? So on to the next slide, the gold to silver ratio. This is a really important tool, if not the most important tool that you need to evaluate when you're trying to decide, should I buy gold, should I buy silver? The easiest way, and it's real easy to calculate it, if you take the price of gold and you divide it by the price of silver. Okay, this is a value tool that's been used for over 100 years in the metals markets. If you see here, the average during the 20th century was 40-1, meaning you could buy 40 ounces of gold, 40 ounces of silver for every ounce of gold. What we know is that historically speaking, when this ratio gets above 80-1, silver outruns gold 4.5-1 on a percentage basis. We've heard some experts refer to a return to a gold or a silver-backed currency, and that the ratio will tighten as close as 14-1. Best predictions here are, given the 21st century average has been 45-50-1, we look for it to close down to that level. But just as an exercise, I want to show people, if we look at the market today, the price of gold currently is $18.73. The price of silver is just over $22. It's $22.03 right now. That puts the gold to silver ratio at 85.76-1, 86-1 almost. This is profound because this ratio has only been this wide a handful of times before in history. Typically, it's during times of war or turmoil, right? The first time was during the Gulf War. The all-time high and this ratio being stretched out was during COVID. But what we know, given this ratio of just under 86-1, silver is incredibly undervalued when compared to gold. And it tells us that for every 1% gold is moving forward here, silver will move 4.5%. Really, really profound data there. Moving on, right? When do we want to buy gold and silver, right? It's important to consider the dollar, as I said first, because that's the number one factor. The gold and silver share an inverse relationship to the dollar, and all that means in layman's terms is when the value of the dollar goes down, the price of gold and silver moves up. So in considering the value of the dollar, other factors we look at are monetary policy, right? What's the current policy and the forward guidance from the Fed? The Fed does not do things really that surprise us. They usually forecast their moves for investors. So it's important to be tuned into that. We also have to consider geopolitical events, right? Whenever there's times of war or tension politically around the world, like right now, we're seeing Russia and Ukraine, and unfortunately, over the weekend now we're looking at the conflict going over between Israel and Hamas. These are times when precious metals typically soar in value while equities plunge. And then additionally, The other thing that I want to go over just at a high level with everyone is a little bit of technical analysis, right? Like I said to start, we want to avoid making decisions based on emotion, and we want to use the technical analysis to identify market trends and facts that we can trust our decision off of, right? So moving into it here, what's the current Fed policy and what's the forward guidance? Well, we now know that interest rates are between 5.5% to 5.75%, right? From the minutes that we just received 2 weeks ago from the Fed, we know that policymakers are looking for two, but more likely one interest rate hike in 2023, but two interest rate cuts in 2024, excuse me. So I just want to throw this slide up. This slide is from our last webinar that we had with Advanta. At the time, 17 of the 19 governors were predicting interest rates to go above 5% and stay there for 2023. As you guys can see, we're at 5.5% to 5.75%. So the Fed stayed true to their guidelines there, right? In this, it says the majority see rates elevated above 4% through 2025. Morgan Stanley's predicting 26% loss across the board. They're referring to it as the death zone, according to their chief US equity strategist. Michael Burry and Ray Dalio, and for those that I know I explained who Ray Dalio is, Michael Burry being the head of Scion Capital, he's also the individual that the movie The Big Short is about. They're both calling for the mother of all crashes. Meanwhile, we have leading analysts like Philip Streibel forecasting for $28 silver and a move to 30 and 1950 average for gold with moves to 2000. Well, how has that changed? This is what we're looking at now. Instead of 17 of the 19 governors calling for rates to move above 5%, they're already there. 12 of the 19 want to raise interest rates by a further 25 basis points this year. That's one more hike. What this indicates to us, well, interest rates moved to 6%, but we know that the majority are in line with not only moving sideways after that, but they've announced a potential 2 interest rate cuts in 2024. This is a significant change to monitor, right? Previously, if we look back at the last slides, we were expecting rates to be above 4% through 2024. With this new guidance from the Fed, they're telling us rates are going to remain elevated above 5% until 2025. It could be the second quarter of 2025 before they fall below that. Morgan Stanley at the same time has not changed their projections at all. They're still calling for a 26% loss in equities for the year. The significance is, in the last slide we highlighted, Michael Burry was calling for the mother of all crashes. Well, he's now put his money where his mouth is. As of 8 weeks ago, he's now short of the S&P 500 and the NASDAQ 100 to the tune of $1.625 billion. That's 93% of his total portfolio. To put it in perspective, and again, this is the same gentleman that predicted the financial crash in 2008. Michael Burry has come out to say, I may be early, but I'm not wrong. He contends that he will cover this short position until it comes true. Very bold statement coming from someone with his track record. Now, we also have the World Bank has jumped on the bandwagon, as well as analysts like Philip Streibel. They're still forecasting for gold to end the year at 2,000 and silver to end the year at 28. Well, these are significant upticks given the fact you consider we're in October now, right? So $2,000 is a move of roughly $130 for gold, so almost 10%. $28 silver is a move of roughly 27 to 30% in silver. So these are significant moves that we see on the table right now. Moving on, what is the trend in the dollar? I know I stated the dollar is paramount when we're looking at gold and silver. So what I want to go over here, this is a head and shoulders pattern or formation, right? Just to point this out before we go into analysis, if you guys look on the right side of the chart where you see the S's, there's 4 of them, one on either side of this peak. Those S's are the shoulders, the head being the top, okay? Head and shoulders patterns occur when the market trend is in the process of a reversal, okay? So in this case, we can see, it's very clear to see, if you look down in the valley, right before we come up to the shoulders here, we bottomed out in 2021 at the dollar being valued 89 on the index, okay? We then see 10 consecutive interest rate hikes. Those 10 consecutive interest rate hikes had us peak at 115, right? We then have come down to touch a bottom at 102 and bounced briefly back up. What this is telling us is that not only did the dollar go up with interest rate hikes, but the head and shoulders pattern confirms the reverse of this trend into a bearish trend. If we look back at the dollar, again, we see it hit 89 on this chart twice in the last 5 years. If we follow it back to 2008, the bottom for it, which it also hit twice, is 72 on the index. The ultimate predictions for where the dollar is going now that the Fed will not be hiking in the next 10 consecutive interest rate meetings, and as well, considering all the printing and stimulus, is that the dollar will come back to 89 and ultimately 72 on the index. Okay, the main thing that we know is the yield started on the dollar started coming down because we know they're not going higher. Okay, now moving on, I just wanted to extrapolate here in that last analysis. You can see it's not marked, but you see the head and shoulders pattern almost in the middle of the chart. Then you see us move sideways. What this shows us is we come back down to form a triple top. Those 3 peaks at the end are significant. That's a triple top right there. So not only have we reversed the trend in the dollar and it's coming down, but we've established a lower high. So this just confirms our suspicions from the last chart. Additionally, the line that we see go across the top of the chart here, the RSI, the Relative Strength Index, what this tells us is if a particular commodity or equity, or in this case, the dollar index, is overbought or oversold. Readings below 30 and approaching 30 indicate oversold. Readings above 60, approaching 70 and above show that something is overbought. If we look at the RSI, which is in a box in the top right corner, you will notice 61.31 listed there. This goes to show us that when it hit its triple top, the third top there, it was overbought. So it confirms to us that the dollar is moving downwards. We can safely say, based on the analytical tools from the 2 charts in the dollar, that gold and silver are a good buy at this time, based on the fact the dollar is coming down. And we said earlier, right, the dollar and gold and silver have an inverse relationship. So what does that mean? Well, now that the dollar is coming down, as the dollar moves down, the prices of gold and silver move up. It really is as simple as that. Now, moving forward, what's happening in gold? What we have in front of us here, you'll see it quoted as a bullish wedge pattern. You might know this trend on a chart as a flag pattern or a pennant. What you see when you're looking at a flag or a pennant or a wedge pattern is clear direction here initially. If you look at this first white line moving up, that's clear direction of the price trend. It's followed by a consolidation, which we see right here, before the trend is resumed. Now, what happens when you're looking at this is it moves sideways through the pennant. As we move sideways through the pennant and we come towards the point is where we have the breakout. We're right there right now. Now, a breakout, when it comes to the wedge pattern, is either going to be upwards or downwards, right? It can be bullish or it can be bearish. But simple as this, we know that there was an upward trend which is being resumed. Furthermore, the dollar has reversed its trend and is now in a bearish trend. So if we follow the additional data, as well as the fact that we have a bullish wedge pattern here, we can infer that we're going to see a breakout to the upside. The opposite would be as if we had a flag where the trend was pointing downwards, right? That would be a blow off or a breakout to the downside. But right here, we can see in gold that gold is poised to break out to the upside, okay? Additionally, I just wanted to use this same tool here for silver, right? It's not drawn as neatly, but this is two things on the chart. Not only is it a wedge pattern, this also indicates what's called a cup and handle. So if you notice, between the peak in 2011 and the peak in 2021, we establish a cup there. What happens with the price trend moving sideways off of that is it forms a handle. A cup and handle is one of the most bullish tools we can see in a chart, no matter what it is, whether it's Microsoft, Apple, S&P, or silver. The depth of the cup indicates the future price, right? So if we look at this, the total depth of cup, we reach just over $30 here. The bottom of the cup is touching $11.82, the low. If we want to be conservative, let's just say the bottom of the cup is touching $12. That's a total cup between 30 and 12 of $18, okay? This would suggest a potential $18 move to the upside for silver. If we saw that, $18 from where silver is today would point towards $40 silver, okay? As well, this also indicates that flag pattern like I was seeing, and you can see we're getting quite close to the point on the pennant where we're going to see a breakout. Moving forward here, this is a more expanded chart for silver. We were just talking about a cup and handle that's been formed over the last 10 years. Well, how about this for a cup and handle? This cup and handle was formed between 1980 and 2011. For fun fact for people, this is the only multi-decade cup and handle that exists. We only know of this one across all markets, okay? If we look at the depth of the cup here, right, we have a high in both cases. We had a high at $49.82 in 2011 and a high at $48 in 2018, or sorry, in 1980 rather. The ultimate low that we come to here is just below $4 an ounce. So again, this is a $44 cup and handle. A $44 move puts silver at $66. And don't get me wrong, no one's saying it's going there overnight, but it's significant to consider. There's only one of these. These are true data points here that you don't see every day. It's this type of analysis that we want to go off of when we're making a purchase, right? We don't want to go off of hype or what's going on in investor group and Bob's doing this and Jim's doing that. We want to look at the charts, get the technical analysis, and make our decisions based off of that. So what we can tell is that we have the dollar coming down. It's resuming its downtrend. And just to say this at the notion, no one here for a second is saying that the dollar has moved up in value. We all know we've lost purchasing power for the dollar. We're simply looking at the readings on the index, right? So with the readings on the index coming back to where they were before at 89, what we know is that 89 on the index for the dollar typically correlates to $30 silver and $2,000 gold. Last time we got 72 on the index, we reached $49.82 an ounce for silver, and we reached, $49.82 an ounce for silver, and we reached 2,060 for gold. Very, very significant to consider. So moving on here, when you're buying gold and silver, right, you need to make sure that you trust in the analysis. You want financially driven results, ultimately, at the end of the day. I know it states here in the PowerPoint, we make buying bullion, bars, and coins an easy experience. Another thing that I want to get across to everyone, whether you buy metal from Allen House Metals or you buy it from anyone else, please, please, please do not get sucked into buying collector coins. If you want smaller denominations, you can buy 1 ounce bars. Additionally, you can buy rounds. A round looks like a coin. It doesn't necessarily have the same intricate details. Buy bars. Investor bars is what we specialize in. So these are kilo and 100 ounce bars of silver. They're kilogram and 10 ounce bars of gold and platinum. Okay, they're all LBMA approved. The reason I say this is the price for coins and rounds is ultimately much higher than the price you're going to pay per ounce for a bar. And at the end of the day, when you go to sell this metal, most dealers do not reciprocate that additional premium you paid on the buy with a premium on the sell. Meaning, when you go to sell a bar or you go to sell a coin or a round, typically a lot of dealers will pay you the same price per ounce no matter what the product. Okay, we are different than this. We do pay a premium for product, but like I said, at the end of the day, we're here to invest, not collect. Your best move is looking at LBMA, London Bullion Market approved bars, or a London Bullion Market approved mint that produces bars, right? So typically for us, the most popular products we see are kilogram silver bars, mainly coming from the Nadir mint in Turkey, or coming from the Germania mint, which is in Poland. For gold, we see a lot of 10 ounce bars as well as the kilo bars. The most popular mints for these are the Royal Canadian Mint. In addition, we see both Asahi and as an extension of Asahi, we also see Johnson Matthey as fantastic bars to get. That's really where I would direct the attention. Now, as I said before, even though we ship products out of our facility in Dallas, Texas, and we have our storage facility in Dallas, Texas, we are based out of Palm Beach County here in Florida, just like Advanta. We are open 9 a.m. to 8 p.m. Monday through Friday. Please do not hesitate to call us or send us an email to get involved. And additionally, anybody that reaches out and references the webinar will receive a discount on their first purchase, okay? Please don't hesitate to reach out. We're happy to, answer any further questions you may have. And additionally, this was just the tip of the iceberg when it comes to analysis. Any sector of the market that we want to go through, we are happy to take the time and educate you with that. So I want to thank Scott and everybody for attending today. And if there are any questions, please do not hesitate to ask them.
Yeah, Greg, thanks for the great analysis there, especially when you're looking at the markets, the value of the dollar, and showing the historical aspect of it as well. I think is extremely important. Yeah, if anyone's listening live, we have just a few minutes left. We'll take any questions. You can just get those typed into the question box on your screen. Greg, one question I had was earlier on in the presentation, which you were on a great roll, so I kind of just let you keep going. But yeah. When you're looking at and maybe advising and someone and giving them some guidance on buying gold or silver precious metals, what factor kind of does someone's age come in all this? Again, younger, older, does it matter? from when you're looking at the, what percentage of the portfolio that it makes up? Does someone's age come into play at all when you're
For sure.
having that analysis?
For sure. I think 100% it does. Typically, I will say our clients that are 75 plus, that are really at this point, they're looking for stability and not so much capital appreciation. I find the bulk of our clients 75 plus, not only are we directing them, but them by choice, they're choosing gold. If you, at the end of the day, if your objective is capital appreciation, you're just looking to make money. I know silver is the buy there, but I would say, a bulk of our clients that are 75 plus are strongly weighted in gold for that reason. Main reason being, it's not something that they have to check even monthly. They know it's stable and that it's meeting inflation. And at the end of the day, although it's just as easy to liquidate as silver, I would find most of the clients, when it comes to cash and carry, where they're taking the metal home and not holding in an IRA, tend to prefer gold, just from the fact that it's a bit easier to store. But that's a great question. Yeah, I would say ultimately we think a balance of it is ideal. Whether that balance is weighted more heavily with silver or more heavily with gold is often dependent on the objectives of the investor. And if their objectives are just to meet inflation, then typically we find gold is the route for them.
Good. Thanks for the answer. So, yeah, I didn't see any other questions come in, and I know we are right here at the time limit. So, Greg, I do want to do it again. Thank you very much for your time coming on today. Again, great information. Again, if you're listening to this live, the recording will be on our YouTube page. We'll be emailing it out to everyone. But importantly, those people who are listening to this is a recording on our YouTube channel, please reach out to Greg with questions you have on precious metals, the purchase process, what's involved in the process itself, getting some other guidance and some advice there. Any questions on the IRA side, certainly reach out to me as well. Obviously, Greg's contact information is here on this slide. On as far as mine, if you have questions on the IRA side, you can reach me. Here's my phone number, my email address as well on the IRA. So, Greg, thank you again for just a great, very thorough educational presentation today on gold and silver.
Yeah, and thanks for having us on, Scott. And again, thank you everyone for attending. These are really fantastic events. And I know we're not completely finished this one yet, but we're looking forward to the next.
And I think, as we look to, obviously you showed the charts there, kind of what some of the wiser minds or the feds were saying, earlier this year compared to now. That's why I think we'll look to bring you back again. So for anyone listening live, you will look for the early part of next year to kind of see what happened here as we go through these last few months of 2023 and start 2024. And if those predictions held true as to what the folks at Morgan Stanley were saying or the feds as far as the interest rates go.
100%. Awesome. Thank you, Scott.
All right. Thanks, Greg. Again, thanks everybody for listening live. We look forward to seeing you on our future webinars.